Good morning and welcome to the ADS Securities Markets Update. In line with our estimates, the US dollar finally gave up yesterday most of its gains against most of the major currencies on more and more negative economic releases from the US, leading the US dollar index to decline back toward 95.40s level, which again represents a solid support area that we have seen in the past few weeks. But at the same time, the technical indicators are also lower and turning more bearishness also on most of the time frames, especially on the daily chart, which also keeps our downside view valid throughout the week, or at least until the end of the US session today. For the time being, the next support area also stands at this level, which is the 200-day moving average at 95.23, which represents again the 200-day moving average as if a break, which should be watched very closely, as a break below that or through that support may clear the way also for further downside below the 95 levels. The US economic releases yesterday came in with mixed outcomes, but at the same time they are mostly negative. First of all, the jobless claims indeed declined by almost 6,000 down toward 275,000 as widely expected, after revising the previous reading of the week before, reading toward 281,000 instead of 282,000. However, the continuing claims increased toward 2260,000 last week, up from 2259,000, while it had been anticipated also to decline back toward 2253. Most importantly, the import prices came in also worse than expected, declining by on the month-over-month. First of all, the prices declined by the most since January, declining by 1.8% in August after declining by 0.9% in July. And this is also the second monthly decline in a row, which is not seen since also the beginning of this year. But at the same time, the year-over-year prices also fell by more than expected, declining by 11.4% compared to 11.1, the estimated ones. But moreover, the previous reading has been also, or for July, has been revised even toward 10.5% instead of 10.4%. And this is the biggest year-over-year decline since 2009, or since the financial crisis. The wholesale inventories unexpectedly declined by 0.1% in July also. This is the import prices. The wholesale inventories declined by 0.1% in July compared to a rise of 0.7% in June, while it had been anticipated to rise by 0.3%, posting the first monthly decline since also May of 2013. However, some would argue that declining inventories means higher sales, but this did not happen this time. However, the wholesale trade sales unexpectedly declined by 0.3% in July, despite the fact that estimates were to rise by at least of 0.1%, and this is also the biggest and the first monthly decline since March of this year. As for today, there was no economic releases in Asia, while few economic figures will be released during the European session, but unlikely to have any major impact on the market. But during the US session, there are also some economic releases which may have a notable impact on the market as we wait for the PPI data, the core PPI, and finally the University of Michigan Consumer Confidence Index. Going to some technicals quickly today. The euro, first of all, the euro managed to close yesterday very strong and well above its 200-day moving average, which is this line here that we also noted in our previous report, rising also to as high as we reach above almost 13. But at the same time, the technical indicators are also rising gradually on the daily chart and most of the time frames, which basically also suggest a further decline, or further gains ahead. A few weeks or last week, we noted that traders should not short the euro aggressively, as increasing the issuing limit of the QE does not mean increasing the QE. In short, there is no change in the monthly purchases, and it stays at 60 billion euros. Therefore, the latest decline in the euro is basically considered as a short-term retracement before the uptrend continues. In the meantime, the next resistance level stands at 1330 or 1325, which also represents another top in here, and at the same time it's 38.2% retracement from the recent declines. In addition to that, we might also continue to rise toward 114 if basically we broke above that resistance. As for the British pound also, and this is the final chart for today, the British pound also continued to rise after retesting its 200-day moving average. A few days ago we mentioned that it's a break and then another retest and another rise. So this is what happened yesterday, and continue to rise toward 54.60s yesterday, and also nearing the first resistance area that we mentioned in our previous report at 54.92, which also represents the 50% retracement from the recent decline from 158.19 toward 151.65. For the time being, we need to to watch this level very careful, as a break above that resistance may clear the way also for further gains toward these two lines, or these two moving average, which basically stands at almost 55,823, which is the 100 and the 50-day moving average. This is it for today, and this is it for the week. You can follow us on our social media sites, Twitter, Facebook, and YouTube, to get the latest economic releases, reports, and analysis. I'll see you next week from London offices in ADS Securities London. I'll see you once again next week. Thank you for watching.